Brandon, let's talk about Canada's labor market. The unemployment rate has been dropping. What has been driving job gains?
That's right. Well, we've seen over the past few months the unemployment rate come down to where in March was multi-decade lows, lower than it was pre-pandemic, which itself was a pretty strong strong result. And I think driving that growth, somewhat surprisingly, is just a broad-based level of job growth across a whole range of different sectors. Throughout this pandemic, we've kind of seen that pandemic exposed sectors like accommodation and food services and hospitality as areas where there was a lot of room for catch up, and there still is. And yet, looking at the kind of level of overall employment across different industries, that those areas of the economy are still way down and aren't in particular driving these job numbers. There was some rebound after the Omicron wave at the very start of 2022, but really we're seeing growth across a whole range of areas. Construction has been a nice source of growth recently. Professional services continues to rise. This is sort of white collar services, which includes tech, it includes marketing and engineering and other white collar areas. Employment there is up 14% from its pre-pandemic level, just like really impressive growth that hasn't cooled off. But I think that's what we're kind of waiting to see when is going to finally hit now that the overall labor market is in solid shape.
You had just touched on some of the sectors that maybe haven't seen that full employment just yet, like hospitality and retail. What are some of the other sectors maybe that you're seeing that are slowing, or are there any sectors that are slowing?
I think there are a few areas of the economy where things might have plateaued a bit, and that's both in terms of the job numbers and the level of employer demand. So one area that I'm tracking is manufacturing. And here we've seen a bit of a sort of flattening out of the growth, even despite strong employer demand. And I think one of the constraints there are factors going on in the global economy, like challenges with the supply chains. So capacity utilization in the manufacturing sector isn't quite what it was pre-pandemic, even though there's really strong levels of global demand there. And that's probably weighing on employment there as well. Another area to think about kind of slowing momentum isn't so much in a pullback in the actual job numbers, but in terms of employer demand. So there are a few areas of the economy where employer demand didn't even fall very much at the start of the pandemic, like in nursing and other areas of the healthcare sector, where we've seen recently when it comes to job postings, things cool a bit. So things were really strong throughout 2021, and they remain strong today, but we're not seeing the same pace of increases in job postings in areas like nursing and personal care, home health that we saw last year. So a sign of that maybe in some areas of the economy, employer demand might have hit its limits in terms of how high it can get, but nonetheless is still strong, and one where there's still plentiful opportunities for job seekers. Just hopefully at least a sign that the growth in shortages in certain sectors like healthcare is starting to level off.
Let's talk about I guess this idea of businesses struggling to fill a job vacancies and foreign workers coming in to fill that void. What is your data telling you?
Sure. So there are a few things to think about when it comes to filling vacancies and foreign workers. One, I think, is that there can be a difference between sectors and individuals' employers' ability and difficulty in finding workers and expanding, and a sector's overall ability to expand. And what I mean by that is that we've seen really strong pace of job growth even into this year as the unemployment rate has gotten quite low. And so that's a sign that at least at the headline level, several different industries are being able to add jobs fairly quickly. But that the thing is, though, that while overall industries are able to expand, for individual employers, it doesn't necessarily mean it's going to be easy to find workers, because they're just competing with each other for a limited pool of workers. And so we're seeing on Indeed, job postings in mid-April were up 71% from their pre-pandemic level, still showing strong numbers. And so that's just competition for a pool of workers where the number of workers who are unemployed and actively searching is starting to shrink, raising the pressure on hiring from the currently employed pool of job seekers, which means challenges in retention and the need to poach workers from other companies. And so tougher conditions for individual employers, even as we see the overall employment situation grow quickly. With all that context in, we now have new expansions in the temporary foreign worker program. And here, I think employers are ready to use these programs. They're the ones who've been pushing for their expansion. When it comes to foreign job seekers, I definitely think there is appetite to fill these roles. So we track on Indeed the share of job seeker clicks on Canadian job postings that are coming from abroad. And what we saw was, especially last year, a noticeable increase from the around 5.5% pre-pandemic share of clicks on Canadian postings from abroad to closer to 9%, just below that as of February. And that was pre-expansion of this nationwide temporary foreign worker program. So if foreign job seekers react to those policy changes, that means that there will be workers interested to sign up for these programs. What it means for the overall labor market, though, is another question. There's first, I think, the question of what it means for domestic job seekers, and there are definitely concerns of what happens to wages for different areas of the economy as more temporary foreign workers come in. And then from employers' point of view, there can be the temporary foreign worker program can help hiring conditions, but at the same time, is it enough to offset shifts in the domestic market? And so these will be all things to watch as we head into the rest of the year.
Looking ahead to the summer, just wondering what your, I guess, speculation is, what the summer jobs picture will look like in 2022 versus, I guess, pre-pandemic levels.
Mm-hmm. I'm expecting quite a strong summer job market, especially on the employer hiring side, just because that fits with the overall story of the just general state of employer demand. We're seeing job postings across a whole range of areas quite strong. Areas that might be temporarily impacted by pandemic waves, now also quite strong, like in food services, and areas in recreation where things have been a bit subdued over the past 2 years, hopefully getting more back to normal. And so I think that means opportunities for summer job seekers. Whether people are particularly interested in those jobs, though, is another question, especially if there are opportunities for more kind of full-time permanent roles. Then some people might not be as quick to jump to seasonal opportunities as they have in the past. And so that means for employers trying to fill those roles, especially in those summer months, they need to sweeten the deal. And whether that is in terms of wages and compensation, or flexibility, or even stability, and potentially offering employment beyond the summer months for some, or flexibility in terms of hours and things like that. Overall, we're in a challenging hiring environment for employers. And I think that's going to be the case in the summer months as well, when this hiring really needs to happen all at once.
Brandon, I've heard you mention wages a few times. When you take a look at this picture of inflation, an overheated economy that the Bank of Canada is hoping to address, we're almost at full employment. How does this affect wage growth?
Sure. So what we're seeing right now is that Canadian wages are showing a little bit of momentum recently. The latest labor force survey had them up 3.4% year over year. That's that's actually slightly 3 percentage points less than the headline level of inflation. Whereas headline inflation in March running 6.7% versus 3.4% wage growth, Canadian paychecks are not keeping up with the cost of living right now, and so this creates a few different issues. From the household side, it's a clear erosion of purchasing power, and one that I think people are increasingly concerned of. From the employer side, we were already heading into this year, entering an environment of where the ingredients for wage growth, whether it was lower unemployment, whether it was really strong job posting numbers, were coming together to support stronger wage growth, both for employers to hire new workers and also retain their existing staff. Now we have this added dimension of rising cost of living. And so I think for employers, this is something where another potential pressure to raise wages it could come in. It's going to be something that'll be really important to watch in the second quarter as the economy sort of fully emerges from the Omicron wave. And it's something the Bank of Canada is watching, because this is sort of the recipe that today's inflation could start becoming self-enforcing. And what I mean by that is, right now, a lot of Canadian inflation is tied in areas of the economy that don't have a necessarily direct link to the labor market. So areas like the goods, durable goods, which are tied to global prices, and food and energy, which are also set in global markets. And then the housing market, which is a domestic issue, but one probably more tied to the stance of interest rates rather than the pace of wage growth in the Canadian economy. Where wages come in is for the price of services that where the cost of labor is a key input into. If those prices start to rise as employers are competing in a tight labor market, but also trying to help their workers' paychecks match the rising cost of living, that's an area where there's a potential pass through from wages to prices directly, and where we could see a self-reinforcing cycle of rising wages, rising prices, and sort of those two going hand in hand back and forth. And that's what the Bank of Canada is trying to avoid in its current tightening cycle. The balance will be trying to avoid that by cooling certain areas of the domestic economy without going too far and tipping things over into a recession.